Have you ever looked at a startup's corporate history and just thought, wait, how on earth did they get from point A to point B? I mean, we see tech companies pivot all the time, right? A software company tweaks its target audience, or a hardware brand updates a product line. That's totally normal. But every once in a while, you stumble upon a corporate evolution so completely bizarre, so incredibly unpredictable, that it honestly feels like something out of a movie script. Today, we're looking at a company called Siyata Mobile. This is an entity that has completely transformed its core identity, not just once, but multiple times, literally shedding its past like snakeskin just to survive in an absolutely unforgiving market. And that brings us to the massive, burning question at the center of all this. How does a company that builds rugged, heavy-duty two-way radios for garbage trucks, utility workers, and first responders eventually wind up merging with an international AI gaming developer? I mean, on paper, it sounds like you've grabbed two puzzle pieces from completely different boxes, right? Well, let's dive right into the story. Okay, to really understand this wild trajectory, we have to rewind back to their frankly weird origins. If you looked at the legal predecessor of this enterprise prior to 2015, you wouldn't find a single thing related to telecommunications. Nothing. They operated under names like Big Rock Gold and Teslin River Resources. Yeah, you heard that right. They were literally a legacy metals and mining exploration shell company. But in 2015, they executed this brilliantly strategic, borderline sneaky maneuver known as a reverse takeover. Basically, the founders of a private mobile communications business took over this mining shell just to take their telecom operations public. They officially changed the name to Siyata Mobile, and almost overnight, they traded in pickaxes and mineral rights for cellular spectrum and mobile hardware. So what was the grand telecom vision that prompted this reverse takeover in the first place? Well, it was built on solving a massive, glaring problem in the communications industry. For decades, industries have relied on legacy land mobile radios. Basically, think of your traditional, old-school two-way walkie-talkies. The problem? Those traditional radios operate on very limited spectrums. They've got restricted coverage areas, they are notoriously susceptible to dead zones, and the physical infrastructure is incredibly expensive to maintain. Siyata's vision was to completely replace this aging status quo with something called push-to-talk over cellular, or POC, by moving radio communications onto advanced mobile networks. Suddenly, a fleet of school buses or a team of EMTs has nationwide broadband level scale. You effectively eliminate those terrifying dead zones. And you have to understand the existential weight behind a statement like this. Reliable communication service and high-quality audio are key drivers. That isn't just fluffy corporate jargon. When we're talking about police officers, fire departments, or ambulance crews out in the field, a dropped communication line isn't just an inconvenience like it is for us, it is a critical, life-threatening failure. If a traditional radio fails during an emergency because of some random coverage limitation, the consequences are disastrous. Moving these communications to robust nationwide cellular networks is, quite literally, a matter of public safety. But here is the major roadblock they faced. You can have the absolute best network technology in the world, but how do you actually convince notoriously stubborn industries to ditch the physical radio technology they have literally relied on for generations? I'm going to reveal their insanely clever Trojan horse strategy in just a minute. But first, we really need to understand the unique psychology of the first responder and the industrial worker. Think about the familiar silhouette of a legacy land mobile radio. Public sector buyers and field workers are absolute creatures of habit, and honestly for very good reason. Imagine you're a firefighter wearing heavy, thick work gloves, or you're a cop in a high-stress, high-adrenaline situation. The absolute last thing you want to be doing is fumbling with a fragile glass touchscreen smartphone, trying to unlock it and trying to find some app just to talk to your team. No way. You want tactile feedback. You want a heavy, durable device with physical knobs and a giant, chunky button you can press blindly. You want a simple, single-purpose tool. And this brilliantly illustrates Siyata's solution. Enter their flagship SD7 device. This thing is their literal Trojan horse. To the user out in the field, the SD7 looks, feels, and operates exactly like an old-school walkie-talkie. It's got the heavy-duty casing, the tactile knobs, the rugged design, the whole shebang. But secretly, inside that familiar shell, it packs the sophisticated power of a modern 4G and 5G cellular device. They basically gave the workers the exact physical experience they demanded, while quietly upgrading the network plumbing to next-generation cellular right behind the scene. So the absolutely crucial point here is how they successfully bypassed the competition. If Siyata had tried to build a standard, rugged, touchscreen smartphone, they would have been absolutely crushed by the massive consumer electronics giants who already dominate that space. Instead, they focused exclusively on the super niche radio lookalike design. And rather than trying to sell direct to business and build their own sales force, they partner directly with the Tier 1 telecom carriers. This is a massive, real game-changer move. They got integrated with T-Mobile, secured the highly coveted Verizon Frontline verification, and partnered with AT&T's FirstNet, which is their dedicated public safety network. Basically, they let the massive telecom companies do the heavy lifting of selling the network, while Siyata quietly captured the market by providing the specialized hardware. And they didn't just stop at handheld devices either. They extended this exact same Trojan horse strategy into commercial fleets. Enter the VK7 in-vehicle kit. It's designed specifically for school buses, logistics trucks, emergency vehicles, you name it. Again, it replaces multiple confusing gadgets with a single, streamlined platform that feels exactly like a traditional dashboard radio. It even comes complete with a heavy-duty physical microphone. But just like the handheld, it connects the vehicle to powerful data fleet management solutions over those nationwide cellular networks. So by all accounts, this product strategy was incredibly smart, right? Siyata was gaining serious ground with massive fleets and government agencies, but they were about to collide head-on with a very harsh truth about the hardware business. What happens when having a great market-certified physical product just isn't enough to survive? I'll explain the brutal realities they faced and the massive company-altering pivot they were pretty much forced to make. Here's the thing. Building hardware is a brutal, unforgiving grind. Even when you design a genuinely great device, you are constantly battling persistent operational costs. You've got to manage incredibly complex international supply chains, physically manufacture goods, store inventory in warehouses, and constantly pour money into intense research and development just to keep up with rapidly changing cellular standards. This creates a sort of structural deficit. Your revenues are just constantly being eaten alive by the massive overhead required just to keep producing the physical plastic and silicon. To stop the bleeding, Siyata had to execute some really aggressive strategic defensive moves. They spent intense periods consolidating their global operations and cleaning up their corporate structure. But more importantly, they announced a genuinely massive logistical undertaking, shifting their handset production away from overseas factories and bringing their manufacturing back to US soil in 2025. This move was specifically designed to drastically reduce their international supply chain risks and put them in a position to take full advantage of domestic telecom infrastructure incentives. But even with all these operational cleanups, they realized they needed a fundamental shift in their DNA, which leads us to our next major turning point, and back to that hook from the very beginning. Where does a massive AI software pivot leave their flagship hardware and their loyal first responder clients? The answer is probably going to completely change how you look at hardware startups from now on, because the final piece of this puzzle involves completely abandoning the idea of being a pure hardware company. Which brings us to the most shocking culmination of their entire journey. Siyata Mobile signed a definitive agreement to merge with Core Gaming, an international AI-driven mobile games and applications developer. Just let that sink in for a second. A company that makes physical walkie-talkies for garbage trucks and police cars is merging with a company that builds globally scalable artificial intelligence and entertainment software. On paper, it sounds completely out of left field. There's no way that makes sense, right? But actually, when you dig into the mechanics of it, this match makes a brilliant sort of strategic sense. You see, SYTA has already built the highly regulated carrier-grade global plumbing. They've done the hard work. They have the Tier 1 telecom partnerships, the hardware patents, and, most importantly, the high-trust government and first responder contacts. Core Gaming, on the other hand, provides an infinitely scalable AI software engine. By combining the two, they can suddenly push advanced AI capabilities directly into defense, public safety, and logistics. We are talking about utilizing SYTA's hardware to deliver AI-driven training simulators, edge diagnostics, and secure digital infrastructure directly into the hands of mission-critical workers. This merger effectively creates an entirely new category of business. They're calling it a hybrid telecom AI company. They're leveraging their physical carrier-approved communication networks to become a highly specialized digital software and AI distributor. They finally realized that the physical handset, that brilliant Trojan horse they built, is ultimately just the delivery mechanism. The real long-term value, the true massive scale, lies in the intelligent software running through that hardware. Let's just take a step back for a second and look at this incredible documentary like arc. In just a decade, this single entity morphed from a speculative mining and metals shell company, engineered a reverse takeover to become a telecom hardware provider, fought the brutal hardware wars to launch flagship cellular devices, radically restructured to move its manufacturing to the US, and is now fundamentally transforming its entire corporate structure via a massive AI gaming merger. I mean, it is absolute proof that radical adaptation is literally the only absolute rule in the tech sector. Which leaves us with this final, truly provocative thought. We always hear that famous phrase, software is eating the world. Well, when you look at the grueling realities of supply chains, managing inventory, and physical manufacturing, is the ultimate survival strategy for a legacy hardware company to simply become something else entirely? How many other hardware brands currently sitting on incredibly valuable distribution networks but struggling with physical margins are going to have to make a similar AI software leap just to stay alive? It is a fascinating evolution, and definitely one we will be watching very, very closely. Now let's see its financial data, starting with the raw historical numbers of Siyata Mobile. Right before this massive $160 million merger completely transformed the landscape. When analyzing any public market transaction, especially an uplisting of this magnitude, the balance sheet tells the true story. And in this case, it's a profound story of a legacy hardware company fighting for survival, ultimately forced into an aggressive strategic pivot to reinvent its entire DNA. To really understand where this new entity is heading, we first have to understand exactly what it's running away from. Okay, let's look under the hood at this baseline. Now, on paper, top-line revenue actually grew to over $11.6 million in 2024, but the underlying unit economics, they were deteriorating rapidly beneath the surface. The cost of sales just surged, slashing gross margins practically in half, falling from 32.3% down to a highly concerning 18.4%. Even more alarming for institutional investors digging into these filings is that the net loss basically doubled year over year to a staggering $25.2 million. So the legacy hardware model wasn't just burning cash, it was essentially incinerating it, totally crippled by supply chain pressures and an inability to hit profitable scale. But wait, Q1 2024 did show a flicker of operational stabilization. Notice that 30% year-over-year revenue bump up to $2.4 million, which came with a sharp margin recovery right back up to 36.6%. Now, this bounce wasn't just some lucky accident. It was largely driven by a major distribution victory, getting their flagship SD7 handset stocked as a standard product at 3 of the 4 major US cellular carriers. Operationally speaking, the gears were finally starting to catch, and that distribution network was beginning to yield some tangible results. Still, that stabilization, it was basically a drop in the ocean. Because despite those quarterly improvements and the newfound carrier traction, the legacy business was dragging an absolute anchor, a massive $116 million accumulated deficit. Take a second to really let that number sink in. For a microcap stock, a deficit of this size isn't just a hurdle, it's a structural chokehold. It completely eliminates the ability to raise standard, affordable debt, leaving management with essentially one choice: execute a transformational pivot right now or face total financial extinction. So how exactly does a cash-burning entity escape a $116 million black hole? Well, you definitely can't sell your way out of a deficit that deep using low-margin hardware. To understand their survival strategy, we have to dissect the mechanics of the core gaming merger. This isn't your standard run-of-the-mill acquisition. No, it is a complete structural overhaul, meticulously designed to alter the financial profile of the company literally overnight. Let's step through the timeline and see how this financial engineering actually builds. It kicks off with a $160 million valuation injection via the core gaming merger, which was structurally supported by a 1-for-4 reverse stock split in October 2025. Now, this capitalization restructuring wasn't just cosmetic, right? It was executed specifically to meet exchange requirements, secure institutional access, and forge a brand new identity on the Nasdaq capital market under a highly marketable AI-focused ticker, CHI. They are leaving that hardware legacy in the rearview mirror and fully wrapping themselves in the artificial intelligence narrative. And this brilliantly illustrates the asset they acquired to actually execute that narrative. They bought a highly profitable AI-driven mobile publisher that's generating roughly $80 million in standalone 2024 revenue. Just look at the sheer scale of the digital footprint here. A portfolio of over 2,100 games, 750 million lifetime downloads, and a massive 43 million monthly active users spread across 140 countries. More importantly, it utilizes a proprietary AI-based marketing engine to monetize ad partners. They are fundamentally injecting high-margin software revenue right into a historically low-margin hardware shell. Diffusing this highly scalable digital business into the legacy telecom structure. The newly formed Core AI Holdings is targeting an aggressive $100 million in combined revenue for 2025. The stated thesis for management is crystal clear. Create a direct, immediate path to profitability, turning a cash-burning telecom entity into a self-sustaining AI-powered revenue machine. But as any experienced investor knows, projecting ambitious numbers in a proxy statement is the easy part. Executing them in the brutal public markets is another story entirely. But to figure out if that $100 million target is a realistic projection or just a pipe dream, we really need to analyze the total addressable market they're attacking. Growth models in the public markets require expansive macro tailwinds, especially when you're executing a turnaround story of this magnitude. I mean, you can have the absolute best technology in the world, but if the sector isn't growing, capital is going to look elsewhere. Fortunately for them, the legacy business is operating in a push-to-talk over cellular or POC market that is experiencing explosive expansion right now. We're talking projected growth from $7.5 billion today to over $16.6 billion by 2034. And this isn't just organic, casual growth. It's being driven by a systemic, mandated industry shift. First responders, emergency personnel, massive enterprise fleets, they are all being forced to migrate away from outdated legacy radio networks over to modern, high-speed 5G broadband. So the wave of demand, it's very real. When you combine the underlying telecom infrastructure, including up to $1 million in near-term milestone payments from T-Mobile's priority program, with a strategic shift to U.S. manufacturing, you get a really unique hybrid play. Moving manufacturing stateside in 2025 isn't just good PR. It severely de-risks their supply chain from geopolitical tensions in China, which is exactly what institutional capital wants to see. Oh, and importantly, to appease the folks who suffered through the hardware years, legacy shareholders are guaranteed a 10% equity stake in this new entity via a special stock dividend. However, and this is a big however, as any seasoned investor knows, a high-growth narrative and a flashy new AI ticker symbol do not magically erase systemic balance sheet risks. While the upside is being heavily marketed, objective public market investors absolutely must rigorously weigh several severe red flags before deploying a single dollar of capital into this newly merged entity. The first red flag is structural vulnerability. Despite expanding those carrier relations across the telecom sector, a staggering 61% of the legacy hardware revenue is dangerously concentrated within a single cellular distribution partner. Think about that. This is a massive single point of failure. If that primary partner suddenly changes their procurement strategy, negotiates tighter margins, or hits their own financial distress, the majority of the hardware revenue pipeline could just collapse overnight, leaving the new entity totally scrambling. Second up is fundamental market compliance. Nasdaq officially slapped the company with a warning after shares traded below the $1 minimum bid price for 30 consecutive days. Now, sure, they have until January 2027 to regain compliance naturally, but this creates a ticking clock for institutional viability. Major funds, pensions, institutional capital, they have strict non-negotiable mandates prohibiting them from holding sub-dollar stocks. This essentially cuts the company off from major liquidity pools and forces management into a defensive posture. This exact deal listing pressure is what forced the 1-for-4 reverse stock split in October 2025. Make no mistake, guys, this was an aggressive mechanical maneuver designed solely to artificially inflate the share price past Nasdaq's $4 initial listing requirement, just to clear the runway for the core gaming merger. While it solves the compliance issue mathematically, the market tends to view reverse splits highly skeptically. They basically act as a cosmetic bandage, destroying the total share count without curing the underlying business fundamentals that caused the stock to decline in the first place. Which brings us to perhaps the most immediate pressing threat to shareholder value, the newly launched $3.54 million at-the-market or ATM equity program established with Deep Oil Capital. I mean, AI acquisitions sound fantastic, right? But they require massive amounts of working capital to execute. And this ATM is the exact financial mechanism that prospective investors need to watch the closest. Because if it's fully utilized at the prospectus's 33-cent reference price, this ATM program acts as a continuous tap, literally flooding the open market with over 12 million newly printed shares. That would push the total outstanding shares up to nearly 38 million. For existing retail and institutional holders, that represents severe, immediate dilution of their equity. You're essentially taxing current shareholders to fund the company's AI initiatives, build the U.S. manufacturing base, and just keep the lights on during the transition. So, the ultimate test for the market is deciding which force is stronger, Is it the massive cash generation, the digital margins, and those macro tailwinds of the new AI revenue engine? Or is it the heavy, ongoing capital drain, the share dilution, and the supply chain vulnerability of the legacy hardware structure? It's a classic setup. On one hand, the bull case presents this fascinating turnaround, a newly combined entity targeting $100 million in revenue, fueled by immense AI integration, access to 43 million active users worldwide, and a really savvy de-risked shift to US manufacturing. But on the other hand, the bear case stares down a brutal history of massive financial deficits, severe customer concentration, and the looming constant threat of ongoing shareholder dilution just to keep the machinery moving. As Core AI Holdings officially begins trading under the ticker CHAI, the broader market will soon cast its vote. The fundamentals are completely laid out, the AI upside is undeniably massive, but those balance sheet risks are equally severe. It's a highly complex financial anatomy, leaving every prospective investor to answer one definitive question. Are you buying into a revolutionary, high-growth AI hybrid, or are you just providing exit liquidity for a $116 million turnaround?